So imagine this. Every year, you're handing the IRS a blank check with thousands of dollars being owed to them. Or maybe that's your reality. Let's change that. Welcome back to the channel. I'm Harrison Patton, founder of Kaizen Accounting, where we serve business owners with our outsourced model for all of their tax and accounting needs. Today, I'm going to teach you 5 tax strategies that most CPAs wouldn't bother to tell you. Let's get into it. So let's start with the loophole that's so simple that it's criminal that most accountants won't help their clients do this. The deduction I'm referring to is the home office deduction. IRS Section 280 says that if you have a space in your home that is exclusively used for business use, you're able to write off that percentage of your rent from your tax bill. So let's say we have an individual, Mike, who is a freelance designer. Mike incurred $15,000 of expenses for utilities and rent over the past year. Within his apartment, he has a dedicated space that occupies 250 square feet of his 1,000-foot apartment. By claiming the home office deduction, Mike can allocate 25% of his rent and a minimum of 25% of his utility costs to his business expenses. So applying this percentage to his total $15,000 of expenditures results in a deduction of approximately $3,750 right back into his pocket. Mike could increase his potential savings if he could substantiate that his business-related utility consumption exceeds that 25% of the total, allowing for a larger deductible amount. So nowadays, most of us are digital nomads working from home anyways, so you might as well take advantage of the deduction. One thing to note is that it must be legit. You can't have a space that is partially used as a guest bedroom and partially used as your office for your business. It must be exclusively used for your business in order for you to take advantage of this deduction. So, strategy number 2, hire your kids. I'm not joking, you can do this. It's a lesser known strategy, but just as easy to implement. The IRS allows you to pay your kids who are under the age of 18 for helping with your business. So think social media or shredding paper or cleaning your office. And the IRS lets you pay your children a certain amount each year, and it's completely tax-free to them and a tax deduction to you. In 2025, this limit is up to the standard deduction of $13,850. So let's say that we have Sarah, for instance, who runs a boutique. Last year, she paid her 15-year-old child $1,000 per month to manage the Instagram for her business. This included posting and interacting with followers and other social media things that you could just pay somebody else to do. But by doing this and paying her child rather than an outsourced contractor, she's able to cut her taxable income while paying her kids' allowance, and the IRS doesn't sniff any of it. Now, it is important to note, once again, that this comes with a caveat. It must be substantiated with real business activity being conducted by your child. You can't just say your child's doing something when they're actually not. The IRS won't take kindly to that, and you'll likely be assessed a penalty or fines for doing that. Loophole number 3 is the Augusta rule. This has become a little bit more popular in recent years. So the IRS allows you to rent out your home every year for 14 days, completely tax-free, meaning the income that comes in is completely tax-free to you. Now, I'm sure you've heard of the Masters tournament, the big golf tournament that happens every year. That's actually where this rule originated. So there's such an influx of money that comes into that area each year that the IRS was lobbied in order to pass a law that these people living in Augusta, Georgia could rent out their homes for the amount of the Masters and not have to pay tax on the income. Now, I'm not sure what strings they pulled to do that, but there is a lot of money in the area that allowed that to happen. But on the bright side, this applies at a federal level, so you're allowed to do it no matter where you live now. It's not just exclusively used in Augusta, Georgia. So if you live in Dallas, Texas, you can take advantage of this just as much as they can. Now, one way to supercharge this is to hold your annual board meeting at your home. So your business can pay you as an individual to host your annual or quarterly board meetings at the market price that it would cost for, say, an Airbnb for X amount of days at your home in your area. Another way to really power up this strategy is to time it with big events in your city. So say you live in Dallas, once again, and there's a huge sporting event or a huge concert, what you can do is you can time your board meetings up with those big events so that then the market price has risen on your home and what the value would be to rent it out per day. And that way you can charge your business more, meaning you get a business deduction for it, worth more money, but the income coming in is also worth more. So you can kind of combine those to find a way to really just supercharge and make this a very powerful strategy. Loophole number 4 is the S Corp election. So this is once again a more common one, but still under preached by accountants. So once you're making around $50,000 of income, you should really look into making the S Corp election. So what this is when you're making self-employment income, you're paying what is called FICA taxes. So these FICA taxes is an extra 15.3% on all of your self-employment income that you're making. So say that you were a normal LLC business owner making $100,000 of take-home profit, you would be paying state, federal, and FICA taxes on that entire $100,000, which will come out to almost $40,000 combined of taxes. However, if you elect to be an S Corp, you would split that $100,000 of net income up. So you would take $40,000 of a reasonable salary and $60,000 as owner's distributions. And the beauty of the S Corp is that you would only pay the FICA tax on that $40,000 salary. So after running all of the different math to, compilate the difference between the two, you would only be paying $30,000 of taxes in the S Corp situation. So that's nearly $10,000 of savings for simply filling out a very simple tax form that you could probably pay somebody $50 to do for you. Now, once again, I recommend that the happy spot for starting to do this is once you get up to around $50,000 of net income. If you're doing this before, it's probably not worth the hassle and you wouldn't be reaching enough tax savings for it to be a measurable difference. But once you're getting in that $40,000 to $50,000 range, that's a great time to start looking into making an S Corp election. So loophole number 5 is vehicle deductions. So section 179 of the IRS tax code allows you to write off $30,500 in 2025 when you're purchasing a qualifying vehicle for your business. So this includes things like SUVs, trucks, and even Teslas now. So really any vehicle that's over 6,000 pounds and that you're going to use for more than 50% for business use. Once again, if you buy a vehicle that costs $100,000, you can use a percent of that can be written off because it is for business use. So let's look at an example. So picture a real estate agent driving around town, for showings and to look at new properties that they're going to potentially buy and make deals on. So they purchase a Range Rover for, let's say, $60,000. They use it 60% for business use. That's $36,000 in value. But section 179 is limited to, once again, the $30,500 right out the gate in year one. So you're already going to be using a vehicle to drive around. And if it's going to be used for business use, why not use that as a tax strategy to save you money on your taxes? It's important that when you're doing this, you should track your mileage, log all of your business activity, and things like that. So that then if the IRS does come to question why it's used for a certain percentage of business, you have the information to back that up and you can verify the deduction. So there you have it. There's 5 loopholes to get you started on your tax journey. So once again, just to recap, we have the home office deduction, hiring your kids, the Augusta rule, S Corp election, and lastly, vehicle deductions. The old way of accounting is bleeding you dry, honestly. You need to start looking into tax strategy that can save you money so that the money that you're working hard to make is being able to be saved and put into wealth generating assets. So if you have an accountant that's outdated and doesn't push for tax strategy and try to actively help you and be proactive in his planning for you, it might be time to look for a new strategy. So that's it for me, people. Let's make 2025 the year that you're proactive with your tax planning so that you can save money on taxes. Be sure to like and subscribe for more content coming in the future that'll help you and your family build generational wealth. So I'll catch y'all next time. All love, HP out.